Live from Mumbai, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. The dollar emerges as the latest victim of the market turmoil. Stocks and bonds also resuming their sell-off, with nervousness rising over what China may be doing with its U.S. Treasuries. Trump's tariffs on China now add up to a staggering 145%. But the president says he is optimistic that Beijing will eventually want to make a deal. And we'll gauge the impact the trade spats could have on companies offering services from streaming to digital payments. Joining us this hour is the vice chair of Disney's Indian partner JioStar, Uday Shankar. And we have JPMorgan Payments global co-head Max Neukirchen. Our top story today. Despite the fear on the markets returning, President Trump stays confident about his tariff plan, even after acknowledging that it may cause what he's calling transition problems. Trump this week raised the tariff on Chinese imports to 125% to counter America's trade deficit with China and punish Beijing for retaliating against U.S. import taxes. The White House says that's on top of a 20% levy put into place earlier this year over China's alleged role in fentanyl trafficking, raising the total base tariff on the country to 145%.
Well, we'll see what happens with China. We would love to be able to work a deal. They've really taken advantage of our country for a long period of time. They've ripped us off beyond nobody. How people stood for it, sitting in my position, is not even believable.
But it doesn't seem like investors want to wait to find out whether Trump's phone will ring, with Xi and China looking to fight this one to the end. Stocks and bonds selling off again, with the dollar looking like the latest casualty. Avril Hong has been tracking the story. Movements in the market joins us now. Avril, the market sell-off resuming, angst to relief to angst yet again.
Yeah, I mean, it's the twists and turns, right? Markets have been going through this bout of changes on tariff policy from Trump the whole of this week. And we're seeing how the clarifications coming from the White House, 145%, Trump talking about transition issues. Amid all this, while Chinese stocks look relatively composed, which is quite remarkable, and Asia stocks are headed for weekly declines, I think the biggest casualty this week still U.S. assets. You think about how the changes has eroded confidence in U.S. assets, the U.S. economy. The dollar is extending declines in the Asian session after already its worst selling since 2022. And to give you a sense of a disconnect, this is happening at the time when U.S. yields are rising, something we don't really see. What investors are preferring, the other G10s, not just the yen or the Swissy, but the euro as well, Has.
Yes, and the focus on Treasuries, of course. We saw how yields surge as much as 35 basis points. Suddenly, those Treasuries are looking like risk assets.
Yeah, the dent, I think, in their status as safe havens has really been quite keenly felt this week. And we're seeing that particularly the selling on the long end of things, that has resumed overnight and continues in the Asia session. And Haas, amid all this, there is trader chatter, speculation that maybe Treasuries will be brought in as a weapon as China seeks to retaliate against the U.S. Might it start selling U.S. Treasuries? And the likes of SMBC Nikko actually thinks that it already might be doing so. This would be a very, very extreme course of action. And it would also inform the markets traders that China is sort of willing to take this disruption in global financial markets to get more bargaining power against the U.S. Again, this has been a real week of a lot of market disconnect, Haas.
That's right. Whether China will exercise that nuclear option. Avril Hong, thank you so much for that. Let's get insight with our guest, Karen Manna, portfolio manager at Federated Hermes Karen, good to have you with us. I mean, it does seem like there's a lot of confusion, especially in the bond market. 1 minute it is relief, the next minute it is back in angst. I'm just wondering how you're reading that confusion.
Pleasure to speak with you. And it is such an extraordinary time and a day's end exhausting as such. We've seen yields tumble and then surge again as the markets really try to consider what this long-standing trade war is going to mean with China and the underpinnings of what we've set off with the rest of the world. You know, we utilize our Treasury rates as our risk-free rate from which we price all of our other fixed income investments. And when the market, the U.S. Treasury market, is trading like this, that becomes difficult. But I do want to highlight right now that fixed income across portfolios, while maybe surprising and behaving in an unusual way, year to date has benefited a broader portfolio construct. So the yields are attractive here for investors, although perhaps not behaving as we typically expect.
And that's just it, Karen. The market's not behaving the way we would expect. Is the Treasury market actually broken?
I don't know that I would go as far to say as broken, misbehaving for sure, but what is behaving as we expect right now, truly? And I think, you know, we've gotten caught up in relationships that have held over time, right? Typically, the dollar would strengthen in an environment like this, and it's actually weakening. But I think what we're seeing in the Treasury markets is in all a repricing of risk. We went into the tariff announcement perhaps thinking that growth would fade more than inflation would increase because tariffs cut both ways. They impact growth negatively, and they have the price impulse that can increase inflation. But what we're seeing here now is a market that's more caught up with the risks of the longer portion of the market and less so with the growth and what the Fed can do at the shorter end of the curve. So at the 10 and 30-year part of the U.S. Treasury range, what we're seeing is pricing in of risk. We sometimes refer to that as the term premium, but that longer term bond, investors are going to want to be paid for not only inflation and risk, but what is going on with our government and our relationships with others around the world.
Even as we talk about a reassessment of risk, I'm wondering if the damage done to treasuries is in fact permanent. Do you foresee demand for treasuries from the international market easing from here? Lots of reports about how people are looking for alternatives to treasuries.
They could be, and it stands to reason, right? We've definitely addressed our relationships with the broader world and are seeking to make change in historic trading patterns and relationships. But I do think that the strength of the United States economy will prove to be resilient and the underpinnings of the Treasury market are strong. We're simply searching here for price and a better way to price in that risk. Case in point, we did see two very strong auctions of the three this week, where behavior on the 10-year bond and the 30-year bond actually came in better than anticipated, with stronger underlying stats within that pricing action. Also, we have seen where foreign buyers have been stepping away from buying treasuries for quite some time. Could the moves of the administration last week on tariffs have exacerbated that? Sure. But today, again, we saw strong support for the 30-year bond at the auction and reasonable statistics.
A reasonable question that people are asking is whether China will exercise that nuclear option. Earlier, we talked about how China's holdings in treasuries is huge, $760 billion. If China were to, sell just a part of it, that could be massive implications on the market. How are you assessing that risk?
We watch that risk very carefully. Unfortunately, it's difficult to get our hands on that data in the near term. So we watch, patterns and timing of selling in the Treasury market for indications. But we have a sense that it's really a combination of multiple factors at work against the U.S. Treasury market here, particularly at the long end. Yes, China could be stepping back. They could be, posting significant sales. We could also see other countries around the world opting to pare back their exposures or participate less in the US, as you said, as they look for alternatives. And the alternatives are there now. You can see attractive yields in other markets that give folks optionality rather than simply focusing on the US. But in turn, I do think that that risk premium and assessment for how much you need to be paid to own the 10 and the 30-year is also very, very real. So I see it as a combination of factors more so than simply the action of China.
Karen, give us a sense of what it may look like if China were to sell its holdings of treasuries. It holds, of course, almost 10% of all the total treasuries held by international investors. How might this play out?
It would play out likely with a continued steepening of the curve, but I've also read that a good amount of their holdings are at the shorter end of the curve, so we would have to see some action there as well. But it's really a pretty dramatic step for China to do that. I'm not saying it's impossible, but again, I think markets here are searching for levels to price in a variety of issues. The tariff announcements that were made last week and then somewhat pulled back on midweek, were very significant and I think set the world on edge. If what we're trying to do is reorder how nations trade and what they do, there's so much to consider. And even behaviors of our companies. Are they going to, begin to lay off workers? Are they going to slow down investment? Is the consumer going to respond? I think the habits and tendencies here will really be extraordinarily challenging to predict.
And to be sure, Karen, selling treasuries by China would hurt the U.S. for sure, but it would also hurt China.
Oh, for sure. Right. What happens with their currency? So that's why we're not really seeing that right now, but acknowledging that it is definitely a possibility for the market. But again, all-in yields here, once we settle down, even though things aren't behaving as they normally do, are still very, very attractive, particularly at the front end of the curve. We still see money market funds out through ultra short as a very safe haven for investors, particularly with equity volatility.
Karen, given this beautiful bond market, as Trump puts it, what are you positioning for?
We're positioning for continued turbulence in the markets. We do not have significant positions in duration right now, just a very slightly long with an idea that markets have run too far, too fast here. We do have on a small flattener, similarly in our yield curve positioning, again, thinking that the 530s ratio has moved too fast, too far. So we will seek to profit from that, but in a very tactical and careful and minded manner. These are not broad strategic changes in our portfolio, but simply tactical changes based on the market moving so far so quickly. Where we really differentiate is how defensively positioned we have been in credit. We are underweight to high yield. We like the spread widening here. It's largely been based on valuation, that underweight call. So we are beginning to nibble and chip away at that underweight now, that spreads are no longer extraordinarily tight, but we continue to be underweight to investment grade corporate bonds. We now sit at neutral to mortgage-backed securities. So we sit in a pretty neutral defensive stance in our multi-sector portfolios, awaiting better indications of where these markets might go and where opportunities might exist. So sitting with lots of dry powder.
Right. So pretty much diversified, looking for protection. I'm just wondering whether your assumptions about what the Fed might do this year have changed that much.
They do and they don't, right? I'm back to kind of waffling between that 2 to 3 eases by the Fed. But I've pushed it out. I initially had thought prior to the tariff announcements that we would see that first ease in June, thinking that inflation would continue to hold in a 2.5% to 3% range very broadly, but that employment would begin to soften a little bit so that the Fed could come off what they think is a restrictive stance. I think now with these tariff announcements that inflation is going to be even stickier, perhaps even a little bit tighter. And that's going to make things even more difficult for the Federal Reserve. And they're going to have to hold tight through most of the summer.
Karen, great perspective there. Thank you so much for joining us. Karen Manna, Portfolio Manager at Federated Hermes. Coming up next, we'll hear from Bridgewater Associates founder Ray Dalio as he weighs in on Trump's trade war and the tense relationship with China. Keep it here with us. This is Bloomberg. Welcome back. President Trump's tariff rollout has been marked by confusion as he repeatedly shifts course almost on a day-to-day basis. Here's a look at his recent remarks on his signature trade policy.
That'll be reciprocal tariffs, but we may take less than what they're charging. We have a big day, Howard, coming up next week. It's going to be that's Liberation Day. That's going to be on the 2nd, and that's going to be reciprocal. And I think people will be impressed. I think people will be pleasantly surprised. China, 67%. That's tariffs charged to the USA. So we're going to be charging a discounted reciprocal tariff of 34%. European Union, they're very tough. We're going to charge them 20%. Taiwan, we're going to charge them 32%. Japan, we're charging them 24%.
I think it's going very well. The markets are going to boom. The stock is going to boom. The country is going to boom.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many countries that are coming to negotiate deals with us. I did a 90-day pause for the people that didn't retaliate, because I told them if you retaliate, we're going to double it. And that's what I did with China, because they did retaliate. So we'll see how it all works out.
I don't want anything to go down, but sometimes you have to take medicine to fix something.
It's going to be legendary. You watch. I was watching the bond market. The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. I saw last night where people were getting a little queasy.
Bond market is tricky, but beautiful. Trump's flip-flopping has sparked massive swings across markets, from record losses in U.S. stocks to routes in debt, FX, and commodities. And Bridgewater Associates founder Ray Dalio told us that Trump's dramatic shifts on tariffs are having an impact on America's reputation as a trading partner.
I'm not the politician. I'm not the negotiator. I'm not the person to say whether that style of handling it was better or worse. I would say that it dramatically affected psychology and attitude about the United States' reliability.
We also heard from Dalio about what he thinks needs to be done to fix Washington's relationship with Beijing.
There has to be a recognition that we have a structural problem in that we have an interdependency that the United States can't, either financially or geopolitically because of the risks, be in a position where it's dependent on getting stuff from China. And similarly, for the Chinese, they can't feel safe about getting their capital returns in that way. So in a global economy, you can't have, by definition, large imbalances. So now the question is how to deal with that. That's an engineering exercise. In my opinion, they can have a negotiated way in which the currency is raised. They have to, in one way or another, deal with this, reduce that. So the currency can be raised, the RMB, which would happen by then starting to sell off reserves. The United States likes the fact that the currency would appreciate, and that probably the Chinese like the fact that they can get less in debt by selling off some of their holdings in that dynamic to support the currency, in which case then China has to not just be a manufacturer, but it has to be a consumer. And right now, about 33% of all manufacturing in the world, which is more than the United States, Germany, and Japan combined, is from China. So they manufacture. The United States does not manufacture that, and so what the world needs now is the Chinese to be consumers. So if you were to have that foreign exchange increase and you were to deal with trade together in a sensible way, I think, ideally, then you would also have naturally Chinese doing an increase in monetary and fiscal policies to raise demand, particularly consumption, because exports are going to go down, manufacturing is going to be a problem, so that if they raise consumption and the United States becomes less consumption driven and more production driven, at least those are movements in the right direction. Such negotiations, unfortunately, and such actual big changes are unlikely to take place quickly enough and well enough, is my fear.
Mm-hmm. But, right, I mean, given that and given this possible permanent scarring of U.S. dollar and treasuries, is a U.S. recession actually avoidable?
I think it's likely that we're going to be in a recession. And the question really, recession is, a line at zero, you get, and then, sort of 2 quarters in that. And I think right now it's close call and it's probable. But who cares about, let's say 2 quarters of stagnation or a little bit of negative. I'm more worried about the greater dynamic of these conflicts. I'm worried about more serious issues.
And that was Bridgewater Associates founder Ray Dalio speaking with our very own Francine Lacroix. Suffice to say, over the past week, it's been a roller coaster ride for markets angst in every corner of Wall Street. We've seen how stocks and bonds being sold off in tandem. This is how it's looking for U.S. futures. S&P futures pointing to a flat open right now. Bear in mind that the S&P dropped 3.5% yesterday. The dollar also saw its worst day since 2022. Take a look where the USD, or rather the index, the gauge is right now, currently down by 0.6%. Of course, we've been talking about Treasury yields, in particular, how we've seen 10-year yields jumping as much as 35 basis points. We saw yields rising overnight as well, adding to the 2-day increase by about 10 or 15 basis points as we speak. Now, coming up, our exclusive with JioStar Vice Chair Uday Shankar. We'll talk about India's streaming services and how trade wars may increasingly affect the entertainment business. Keep it here with us. This is Bloomberg.
So, well, it's Trump, tariff, trauma on the portfolio, and the fourth T is what we need to do as investors, which is learning to thrive.
What markets and investors and businesses dislike more than bad news is uncertainty, and we're going to go through a period of uncertainty and an extended period of that at this moment.
The whole concept of defining a tariff solely based on the trade deficit the U.S. has with another country is conceptually flawed.
In this scenario, we're talking about policy changes. And as the U.S. intends to restructure its industrial complex, it will have ramifications to global trade. And
both U.S. and China now have pretty tough stance against each other. I think this will probably last for a while.
We've passed peak shock. You know, the world now knows this tectonic shift is happening. What we can't know yet is the way this is going to flow through to economic activity, corporate earnings.
Some insights from our guests this week digesting President Trump's tariff strategy. Now, China has opened a new front in its trade war with the U.S., this time targeting Hollywood. Authorities in Beijing say they will moderately reduce the number of American films allowed in the country. China is the world's second largest movie market, making it a crucial base for U.S. studios. Shares of entertainment giants, including Disney, fell sharply on the news. Now, China's move may open the door for other countries to target U.S. entertainment services if trade tensions escalate, and it could be a major risk for businesses like Disney's Indian joint venture partner, JioStar. The company says it has nearly doubled its paid subscriber base to over 100 million in just under 2 months since its launch, and is now the biggest media company in India, valued at $8.5 billion, including India's largest collection of TV networks. Joining us exclusively, Uday Shankar, Vice Chair at JioStar. Good to see you in person yet again. We talk about how the implications of the tariffs are reverberating now into the entertainment space. How are you assessing the possible impact?
So I think the tariffs are impacting everybody. They're impacting sentiment, they're impacting people's mind space, and everybody is trying to figure out how to respond. And it's still not settled. You know, all kinds of developments are taking place. It's too early to call how it will eventually impact. As far as we are concerned, luckily, our business is so heavily domestic focused. Our consumers are largely Indian. Our content, and the driver content, most of it is Indian, although we have a huge set of Hollywood consumers, and we are probably the biggest repository of Hollywood content in this country. But in the broader order of things, that's still small.
So, given the fact that China is now retaliating, putting a lid on the number of Hollywood movies coming to China, might you gain from that? I mean, could you get your content at a cheaper price?
Hopefully.
So, that could be opportunities.
Yeah, there are opportunities. Because, look, I think this whole tariff situation globally, it's a huge disruption, but once the disruption settles down, I think there is an opportunity for a country like India. I think we can get ourselves wedged far more centrally in the global ecosystem.
How are you looking at content right now? I mean, how are you looking at competition? Because the likes of Google is a major player.
It's a major player, but, you know, we don't, as a company, as a group, we are not, and as an individual personally, we are not very competition focused. First of all, our ambitions are very different from the ambitions of any other, you know, streaming service or a media company in this country. As far as television is concerned, we really have a very good share of the market. You know, we have channels that go out in every language and offer all kinds of content to all parts of the country, and we have a very satisfactory share of consumption. As far as streaming is concerned, our challenge is not to compete with someone. Our challenge is to create a much bigger market. We want to be the destination for every Indian who has access to connectivity and data to come in every day for all their requirements of premium content. And that's a huge market expansion strategy that we have. So if we just continue to take a share of the existing market, it will still not be satisfactory for us. It will not be mission accomplished for us. For us, the mission is to make sure that every Indian, in the same way that television has gone in this country, despite being pay TV, has gone to every nook and corner. Can we create JioStar as an alternative to television as a bouquet and make sure that we have the attention of everyone every day?
It is about making as much revenue as possible.
Yes.
That is key. And when Mr. Ambani made this deal, this $8.5 billion deal, it is on the basis that Indians will pay for the content they get on the internet. Where are you with that? How are you with pricing? How are you looking at it?
And our trust and our confidence in the Indians' ability and desire to pay has been validated very rapidly since the merger. Now we have just crossed 200 million paying subscribers.
200 million?
200 million paying subscribers. And that is, that makes us one of the biggest streaming services anywhere in the world. And if you consider the fact that we've got 200 million paying subscribers just from India in such a quick time, it's pretty satisfying. So we believe that people are willing to pay. We obviously have to keep the realities of the country in mind, and that is why our pricing is very aggressive. And but we want to get into every household. We want to be, if there is a connected device, we want our content to surface there.
So what's the goal? You talk about 200 million right now. You want to get into every household. What is that target? What's the number you're after? What's the next timeline?
We would like to, as I told you, the targets are moving. When we first came together, we were looking at 100 million. When we crossed that, then we thought we should get to 200 million. Now that we've crossed it, we'll reassess. But the
500 million? Give us a number, Uday.
I can't give you a number.
In 12 months.
I do not want to commit myself on. But in 12 months, we definitely want to, we also want to consolidate. We want to get onto every device. We want everyone to watch us. And then we also want them to watch us more and more, because that is what brings resilience to the business. So now that we have got to a sizable number of subscribers, we definitely want to make sure that we get their attention more and more. So that would be the next phase. We will continue to push for more subscriber acquisition, but driving deeper and deeper into consumption space as far as their attention is concerned is a very important.
So those acquisitions can come within the next 12 months?
Hopefully.
How crucial has the IPL been?
IPL is a very, very powerful asset. IPL is one of the most powerful assets, but we see IPL as a tactical asset, because IPL comes, everybody tunes in for the IPL, and there are other marquee cricket properties that bring people together. But at the end of the day, it's a seasonal property. It's with you for 2 months, and then it's not there for 10 months. And hence, we need to have a content strategy where we are able to engage and draw people's attention throughout the year. And that is where the content that we generate in Indian languages and the content that we get from Hollywood, because of our partnership with various Hollywood studios, that is very, very impactful.
In terms of the IPL viewership,
yes,
can you give us some numbers and the kind of growth you're anticipating?
IPL has, is successful every year. This year it's been particularly successful both on television and on streaming, on our Star Sports pay TV channels and on JioStar. IPL has performed better than ever in the past. So our reach numbers are, we are expecting that it will cross 450 million on JioStar by the end of the tournament, and a similar number on our pay TV channels.
In my conversation with investor Todd Bowley, he didn't, erase the possibility of, buying into a share of an IPL company here in India. Some thoughts on the kind of competition you might face internationally, perhaps?
Look, I think there will be, it's such an attractive property, it's such a giant aggregator of viewership that there would be interest. But, and we would be very, very committed to IPL. IPL, I've always been a big believer in IPL. I think we've played a role in making IPL what it is, and IPL has helped us. We will be committed. But then there is a lot of cricket going around. And it finally comes down to the price.
It's always about the price.
It's always about the price.
Uday, I just want to bring you back to the tariffs and the possibility of that impacting consumption. How are you assessing that? Because in China, for instance, consumption has been hit by expectations that, tariffs will hurt the economy. People are willing to forego their spending power and save more. Might consumption in India be impacted?
Look, first of all, right now, the whole world is in shock. So it's too early to predict exactly how it will settle down. And even the tariff is a moving target right now. The good news is that India, as of now, has, is one of the countries with lightest tariff. 26% is what was impacted, and that's been put in abeyance for next 90 days. And I'm sure the two governments are very focused. India and the US have have been very deep strategic partners. Geopolitical, in terms of geopolitics and in terms of business and everything. The two governments and two heads of states have great relationship. So I think there will be a reasonable bilateral arrangement between us. The other thing for us is that ours is a domestic consumption economy. Our business is driven, even for our advertising business. It's disproportionately domestic companies. But if there is global turmoil of this kind, and if all the fears that everybody is talking about, they begin to come true, then clearly there'll be impact on consumption, and all of us will be impacted by it.
So for the moment, quite buffeted. Uday, thank you so much for your insights today.
Thank you.
Uday Shankar, Vice Chair at JioStar, with breaking news. We have Spain's Prime Minister calling for mutually beneficial relations with China. Prime Minister Pedro Sanchez wants to promote balanced trade investments with China, and he sees Spain as a partner of the EU. Of course, all these comments coming on the back of increasing trade tensions between the U.S. and China, with Trump imposing 145% tariffs on the country. Spain rallying the EU to have a more balanced approach to trade relations with China. Well, in the markets, it is front and center. Avril is back with a look at Indian markets just ahead of that open. Avril.
Yeah, I mean, Has, you talk about the Spanish response, right? It's really interesting how India has been seen as a sort of market that could get these concessions from the U.S. a bit more easily because of the contrast in its tariff response to the likes of China, for example. So this is a market that has actually been able this week to avert the worst of the sell-off. And today, looking at the pre-markets, we are back from a holiday. They are pointing higher. So keep that in mind. Flip the board, take a quick look at the rupee as well, as the dollar continues its declines. It is, I think, among the currencies in the region that are getting that bit of support. In terms of India bonds, though, we're still seeing them coming under pressure despite the bond bulls in India getting fuel earlier in the week after the RBI shifted its stance from neutral to accommodative. Has?
Avril Hong, thank you so much for that. Still to come, we speak exclusively with JPMorgan's Global Payments Co-Head and ask whether rising U.S. tariffs may pose a threat to digital payment services. Keep it here with us. This is Bloomberg. Welcome back. President Trump's tariffs have triggered a tsunami across global financial markets that could yet pose a threat to tech and digital payment services. Some experts are warning that tariffs may have multi-phase implications, including reduced revenues for payment providers. Let's get insights from Max Neukirchen, Global Co-Head of Payments at JPMorgan, which processes over $10 trillion in payments daily. Max, good to have you with us. First of all, give us a sense of how the tariffs are impacting the clients. Are they perhaps holding back investment decisions?
Hello, and thanks for having me. First of all, tariffs are definitely a top-of-mind topic for our clients around the world at this point. They have actually been already a priority item for the last few months. But obviously, in the last couple of weeks, that kicked up to a whole new level. And it is interesting to see how also clients across different industries are reacting to the tariff announcements. This week, I was traveling here in Asia. For example, in the Philippines, there is a lot more of a service-based industry, service-based economy with domestic consumption. Tariffs are top of mind, but it's one of a few topics. My next stop was in Vietnam, and there the economy is much more of a trade and export-based economy, and tariffs have been top of mind. Now, what is important is what you also said. Tariffs is one topic, but it's also what companies are doing around it and with the announcements. We have seen that some companies are definitely rethinking their supply chains, but that takes a long period of time. And most of them are waiting to see what is the steady state where things will settle down before they make further investment decisions.
Max, are they also rethinking their payment platforms? I know that some central banks are expediting their CBDCs, their digital currencies, the digital euro, for instance, so that they can bypass, U.S. payment systems like Visa. What are you seeing?
Most of clients these days are still looking for traditional payment solutions. So they are thinking about their global liquidity and how, in light of all this uncertainty, they can get a better handle around where their cash is and how they manage it efficiently. Second, as they think about their global exposures and supply chains, they worry about foreign exchange rates and how to handle cross-currency payments most efficiently. And then there's also a lot of interest in trade finance and inventory management that we see as clients are now working around the tariffs, thinking about where their inventories are and how they can best handle it. Having said all of this, the question about modern payment rails and new solutions has been top of mind for a while, and we definitely see also, especially in North America, but actually truly around the world, renewed interest in digital currencies and also blockchain-based solutions. But all of this is still early days in the grand scheme of things.
So nothing in the foreseeable future. It will take time. Is that what you're saying?
It will take time, and it's always important for any of these new payment solutions, that could be new payment rails, new ways of managing liquidity, to focus on what problem are they solving and what is the use case that is right out there. At JPMorgan, we have, through our Kinexus platform, a tokenized deposit that allows clients to move money truly 365 days, 24/7, and therefore manage their treasury much more efficiently. That is a real benefit, and we see good adoption there, because treasuries can also program their payments through those blockchain-based solutions, which is a lot more seamless and allows them to run more efficiently. So clearly, there has been focus on those innovative payment solutions for a while, and I expect this to continue, but they always take some time to mature and truly scale.
Max, we've been talking about how tensions are escalating within the U.S. and China. You talked about how, the responses you've seen in some of those Southeast Asian countries. How about in terms of Chinese businesses? How are they navigating? Generally,
the U.S.-China relations are also top of mind for clients around the world. And those are the two largest economies on the planet. And it's, of course, important that we find a good way to collaborate there. And most clients, including me, hope that there will be a good negotiated outcome that allows everyone to continue to thrive well and work well together.
Against such an environment, how are you looking at your own strategy? What kind of growth are you looking at hiring further in this part of the world in particular?
We are very bullish on the outlook of payments, especially midterm and long term. And when we take investment decisions here at JPMorgan, we do this truly with a multi-decade horizon. And there we see tremendous opportunities. There is huge demand from clients to basically help them move money efficiently, conquer new markets, and that is also where we see real upside for our business. It comes through covering more clients in more geographies, but it also comes from rolling out these new innovative payment solutions that allows our clients to run more efficiently and to serve their customers better. So we are actually continue to be very bullish. We invest here in Asia Pacific significantly in adopting new payment rails. I think the future of payments globally is to a good extent shaped here in APAC because we have very tech-forward governments.
But does it mean more headcount here in APAC, Max?
Yes, it does. Yes, it does. We keep hiring. We keep hiring salespeople, service people, product managers, and not just in one country, but all across the region.
Can you put a number to it in terms of the hiring you're planning to do in the next 12 to 24 months in the Asia-Pac region?
We can't put a specific number on it, but it's truly a broad-based growth. And we have seen double-digit growth in terms of payment volumes and transaction volumes. And that also translates into, as I said, growth across the board in terms of the headcount that we have, specifically also in the APAC region. And this is not just for covering the business here. We also have APAC as a key center for our global business, where product innovation, client service happen here and serve the world.
And how about in terms of partnerships and acquisitions? Are you planning to do that, and what would make sense for you?
We have a broad framework for partnerships, in particular with tech and fintech firms. Historically, there was always the discussion, is there a rivalry between banks and fintechs and tech companies? We see more and more a true partnership. We have today globally a partnership with about 80 fintech firms, and the list is growing pretty steadily. And it's a win-win for everyone involved. We provide better service to our clients through broader offerings, and we give good distribution for our fintech partners that also benefit from access to the JPMorgan client base. So it's something we are also very excited about.
Max, before we let you go, just one final question. What is the next big emerging tag in the payment space? What are you looking out for?
At the moment, two topics are definitely top of mind. Number one is AI and AI use cases. And we see some exciting use cases that we are rolling out as we speak. This is around fraud prevention and safeguarding our clients' money. This is around operating efficiencies in payments operations. It's about engineering productivity and client service. And
we
then
have
there
to
is
pick up this
also
conversation
blockchain.
another time. Max Neukirchen, JPMorgan, we thank you so much for your time today. Now, before we go, here's a look at some of our guests. Next week, hedge fund manager Junbei Liu will be joining us to talk strategy. Keep it here with us. This is Bloomberg.